Welcome everyone to Legally Speaking. I'm Kenya Johnson.
And I'm Sonia Brown. Legally Speaking is brought to you by the Georgia Association of Black Women Attorneys, GABWA.
GABWA is a voluntary bar association that seeks to empower women and children and empower our community. Please remember, this show is not intended to give legal advice. So should you believe you have a legal concern, it's always best to consult with an attorney.
It's tax season. So in today's show, we'll talk about the nuts and bolts of the tax code and tax laws.
IRS, the three most feared letters in the alphabet. Today's guest will share valuable insight on this very topic. When we return, we'll hear from experts in the field of tax law.
Stay with us. There's more to come on Legally Speaking. Welcome back to Legally Speaking. Our guests today practice in the area of tax law. We have with us Attorney Julie M.T. Walker and Certified Public Accountant Virginia Green. Ladies, welcome to the show.
Welcome.
Thank you.
Before we get started talking about the nuts and bolts of tax laws, why don't you tell us a little bit about your practices, Attorney Walker?
I am a former senior tax attorney with the IRS here in Atlanta, Georgia. Following my career with the IRS, I served as a traffic court judge for the city of Atlanta. And for the last 7 years, I started my own law firm, and my areas of practice are tax law, DUI, traffic law, and estate planning and probate law.
Thank you, Attorney Walker. And Ms. Green, tell us a little bit about your practice.
I have worked over the last 30 years in the field of private accounting, public accounting, and private industry, as well as nonprofit arena. And I practice doing tax returns for individuals and also for corporations. I consult with small businesses and nonprofit arena.
Excellent. Kenya, I think we have the right experts here with us today.
Yes. Well, now it's tax season, and we're seeing all the advertisements about various types of tax preparers. Can you all tell us who is the person that should file our taxes?
Well, there are several that can be used to prepare your taxes. There are commercial companies. There are also individuals who do seasonal work and some who are open year-round. There are, of course, also the Volunteer Income Tax Assistance Program that is sponsored by the Internal Revenue Service, and those people are certified by the IRS. And there are, of course, those like myself, certified public accountants, who also prepare tax returns.
Also, you have tax attorneys that may prepare tax returns, tax accountants who may also prepare tax returns, and finally, there are enrolled agents. These are people that have to take an exam to be certified by IRS, and they practice before the IRS, and they also prepare tax returns.
So what type of documents and information would a preparer need to file tax returns on your behalf?
It is important, very important, to gather all of your documents in an orderly fashion, if possible. But the important documents are your W-2 form. That's for those who are employed and work with other individuals. And then your Social Security card for every child you intend to claim on your tax return. Additionally, if you are filing for itemized deductions, you must bring in your statements from your mortgage company, all of your checks and documents from your church or any charitable organizations that you have contributed to, your real estate taxes, your ad valorem tax statement. These are typically the documents you need to do. And finally, if you do not work as an employee, many times you will receive what is called a Form 1099, and that will indicate that you work for someone as a non-employee, and that document is important to report the income that you earn.
Okay.
So in addition to these number of documents that I would potentially have to take, would it be important for me to take previous year's filings? Is that something that I should take for the current year?
Absolutely. It is very important and strongly encouraged that you take the prior year tax return that was prepared for you, and if possible, several years. That gives your new preparer a history on what you've typically been claiming, and also the deductions and other. It allows them to actually determine if there are other things that you may be able to take.
Okay. And we're in this day and age where everything's quick, everything's fast. Would you suggest that someone file electronically to just go through that process?
Yes, electronic filing, one, will ensure a quicker refund if you are entitled to a refund, and it also will allow the IRS to get your information in a more timely fashion. But the most important reason that people file electronically is to get a quicker tax return. If you use the mail, your refund could take up to 10 weeks to come by mail.
Well, we always hear terms such as tax credits and deductions. Can you explain to us the difference in that, and what are some of the benefits and things to be aware of?
Yes, a tax deduction is an item that one gets to take from their taxable income, which thereby reduces their tax liability. The difference in tax deductions and tax credits: a credit is an actual deduction from or a subtraction from your tax liability. So as the money that you're paying out of pocket is therefore less. Some of the tax deductions may be student loan interest deduction. If you itemize, you will have mortgage interest, you can have mortgage taxes, you'll also have your, on Schedule A items, some people will also have their charitable donations and also the tax preparation fee. And for those who are employed as well, they can also have non-reimbursed employee business expenses. Now, as far as credits are concerned, those people who have children, they may be eligible for a child tax credit, or if they're underage, under school age children, they may also be able to take a child and dependent care expense credit. And that's just a couple of the credits that they can take. There are many others. Every case is different.
So are there certain tax credits that are available at certain income levels?
Yes, the most beneficial tax credit that serves the most population would be the Earned Income Tax Credit. The Earned Income Tax Credit is for those people who do not typically have high incomes. And the Earned Income Tax Credit, you must have a child to qualify, and there are earned income credits available to those who do not have a child. There are very strict guidelines as to who may qualify for an earned income tax credit, but this credit generally results in you owing zero tax liability, but most of the time the Earned Income Tax Credit provides a refund if you can meet the strict qualifications.
Well, what's the maximum that you can get in an earned income tax credit?
Last year, the average amount for the Earned Income Tax Credit for a family with 3 children was about $5,700.
Okay. And I know that with it being filing season, we see signs everywhere up and down the roads. And I wonder, you know, when they say that earned income tax credits, that they're $3,800 or $4,800 per child. Is that accurate?
That can be a bit misleading, I would say. One could possibly qualify for that, but you have to meet the requirements. That's more of a drawing card to get you in the door. It's just like a doorbuster, if you will.
Okay.
So we caution people and ask them to just beware. As a matter of fact, the IRS has heightened their rules, and the suggestion for tax preparers this year is to certainly make sure you complete the Earned Income Tax Credit checklist, which is required if you're filing a tax return or preparing a tax return for someone that's claiming the Earned Income Credit. And that is due to so much fraud that has gone on claiming Earned Income Tax Credits that were not valid.
Well, speaking of filing, who is required to file by law, and for what population is it optional to file income taxes?
Very good question. The students, a lot of students who work during the summer will actually file a tax return to get the refund on federal and state taxes that were withheld from them, and that their parents will still claim them as a dependent. But the rule from the IRS, however, in terms of who has to actually file a tax return, if one is 65 years or younger and single and has gross income of $9,750 or more, must file a tax return. Or if one is married filing a separate return and has gross income of $3,800 or more, that person must also file a tax return.
Okay. Well, when we return to Legally Speaking, we'll hear more from our guest in the area of tax laws. Stay with us. Welcome back to Legally Speaking. On today's show, we're discussing tax matters with attorney Julie M.T. Walker and certified public accountant Virginia Green. Welcome back, ladies. Attorney Walker, if someone gets a letter in the mail from the IRS, they're being audited, or they owe taxes, or they didn't file, what to do?
What you should do is definitely not ignore the IRS. Get rid of your fears and be proactive, because the IRS will not go away. Therefore, if you receive a notice from the Internal Revenue Service, it is important to contact a professional immediately. I would urge you to get the professional right away. And the only contact that you should have with the IRS as soon as you get the letter is to advise them that you are going to hire someone to represent you during the audit especially.
Now, what if you used a tax preparer to prepare your taxes? Are they in trouble, or is the actual filer responsible for the information on the return?
If you use an actual preparer, the preparer can represent you before the IRS in the case of an audit. However, although one uses a preparer, that person is individually responsible for everything on that tax return, which is why we advise everyone to review the tax return prior to signing it.
Very, very good advice. And with that, if you get that letter, I've always wondered, how long should I keep my tax returns? Like, is there a minimum? Is there a maximum? How long should I hold on to these documents?
I recommend personally that if you're an individual or a small business, I recommend a minimum of 5 years. Some people think only 3 years because the IRS can only audit you for 3 years unless there is fraud on your return. And if you are a larger business and a high income earner, I would say keep 7 years of records, just in case of an audit.
Well, what should you do if you have prepared your taxes, you've submitted it, then you realize, oh, I forgot to add my second job, or I forgot to add something where I earned some extra money? What should you do at that point?
You should amend your tax return. and pick up those items that were inadvertently omitted the first time around. And you'll do a file, whether it be a 1040X, which is an amended 1040 return, or one of the other returns, but do file an amended return and give an explanation for filing it.
Now, Attorney Walker, you mentioned tax fraud. We've all heard of instances where people use other people's children to gain credits or what have you. What are some of the consequences of tax fraud?
Tax fraud is a serious matter, and you do have people that will obtain a Social Security number illegally for a child, and they will submit a return with that child's name, with your child's correct Social Security number. And what the IRS will do, because they have two different people filing a return claiming the same Social Security number, the IRS will send you a letter to let you know that this Social Security number has been claimed on another tax return and ask for an explanation. Now, you, as the good person, you still have to explain and prove that that child was properly claimed on your tax return.
Wow, there's a lot that goes into it.
Yes. Well, Attorney Walker, what are some of the cases and situations that you see in your law practice?
Much of my practice involves taxpayers who, one, have failed to file many years of tax returns out of fear, and because they didn't have the money to pay the taxes that they owe. And I also deal with taxpayers who are being audited by the IRS for something that was claimed on their return that the IRS has disallowed. And additionally, if you owe taxes and you ignore the IRS, they will begin collection actions, which may include a lien on all property that you own, or they will levy your bank account and take all of your money. And finally, they will issue a garnishment to your employer and garnish your wages.
And we've heard about different celebrities having to do jail time as a result of tax violations. How common is that, and what are the extreme circumstances that give rise to jail time?
Criminal tax is a small percentage of IRS work. There are those who violate criminal codes of IRS. A failure to file a tax return is a criminal violation, but the IRS selects those individuals or companies who are egregious. They overstate their deductions, they underreport their true income tax returns. So typically, most Americans are honest and they file their taxes and pay what they owe.
So what do you do? I've seen, this commercial where the tax preparer says this little old lady came in, she had a box, and she said, I hadn't filed in a while. She turns over the box, she has 8 years of receipts, not organized. What do you do if you haven't filed for years?
You contact a preparer, and you are upfront with them. You let them know that you have not filed, and then we begin the course of action to get you on the right path, and that is to sort through that paperwork if necessary, or either have you sort through it, and then we go about preparing those various returns that need to be filed.
So you said a tax preparer. Could the IRS file taxes if I haven't filed?
They can set up a return for you, and of course you will not have the benefit of all the deductions that you may be entitled to. So that's why it's best for you to prepare your own return and claim all the deductions that you can get.
So far we've heard about penalties, fees, and even incarceration. Is there a silver lining? Will the IRS work with you if you can't afford to pay taxes that you owe?
Absolutely. The best thing that you can do is to be forthright and talk to the IRS through a professional, I would recommend, and set up an installment agreement, which is a monthly payment plan to pay your taxes. Additionally, IRS has a program called an offer in compromise, and that program allows a taxpayer that owes a lot of money to negotiate a settlement for a lesser amount because the IRS recognizes that the full amount of the tax liability will never be paid. The IRS has a 10-year collection statute in which they must collect or they can no longer collect after 10 years. So the IRS understands